Welcome back to Startup Accounting 101. These are videos for founders and small business owners to understand accounting fundamentals for running a business. We are finishing the financial projections template in this video. And this template is available for free from score.org. Just go to the template gallery and download the file. I'll have their link in the description below. So again, this video, we're almost towards the end. So we are looking at the amortization and depreciation tab. So on this tab, there's just a bunch of different schedules. So this tab actually starts with all of the loan balances and the monthly calculation, like monthly payment calculations. And so we have the commercial loans, the mortgage, credit card debt, vehicle loans, and the other bank debt that was coming into the business. So I'm going to, let me just split this up. So if we go back to starting point, that's where, let's just say, okay, so that's where this is. So these are all the different additional loans coming into the business. And so these are calculating all of the payment terms for that. I only had credit card debt. So this amount, where does it show up? So this basically gives the loan, probably all of the loan payments come in, from this tab. And so I only have one, so my monthly payment is, $264 every month. And some of that is paying towards principal amount, and then there's a little bit of interest. So that interest should be here. It's for the whole year. Okay, so it's about, so it's about 25. It starts with 25, and then of course it keeps going down as the principal balance goes down. So that's where, so that's like the top of this tab. And then we get down to depreciation. Let me just close this for now. So depreciation. Like we briefly touched on depreciation in a couple of other videos. Depreciation, you'll actually see it in the financials under the P&L, so the income statement. We'll have a line item for depreciation, so that's here. And it also sort of materializes itself on the balance sheet in here. So the accumulated depreciation shows up within the fixed asset on the template side. It will be here, less accumulated depreciation. And then if you have financials that breaks it out, it'll be in the PP&E section, so plant, property, and equipment. So we'll have an accumulated depreciation section here. So if we go back, so we can start from the beginning. So basically, like, what is depreciation? So by definition, depreciation is an accounting method used to allocate the cost of a tangible or physical asset over its useful life. So what does that mean? Like, why do we need this at all? So when we purchase things, it goes onto the balance sheet. So as soon as you purchase anything that's a tangible asset, it goes onto the balance sheet. So that is here. So you've got a whole bunch of, equipment, furniture, building, land. As soon as you buy it, it immediately comes onto the balance sheet here. So here's a listing of all the things that you own. And if we did nothing, then they would stay there forever. Like it just would never go away. And we know that all physical assets, so machinery, equipment, furniture, all of these physical assets, they sort of break down and degrade over time. And to account for that, we book depreciation. So if we go back here, it's an idea that you're using this physical asset over a period of time that's defined as the useful life. And so every year you're booking into your financials, the cost of using that asset. Okay. And that in accounting world is called depreciation. So, and like different assets have different useful life. So that's over here. So in the under depreciation, there's like here are all the different assets, and here is the typical useful life for that assets. So buildings usually last about 20 years, like equipment's about 7 years, and then like furniture is like 5. So these are sort of the standard useful life for these items. And when that happens, when you book depreciation, what it will reduce the overall value of the assets. So the book value is what we see here. So we have a whole bunch of assets, like the full purchase price is here in the financials. In the balance sheet, this is basically from day one, this is what we purchased it for. And then over time, it degrades over time, it depreciates over time. So there's something called accumulated depreciation. And both of these give a net value. So like this net value, you could consider this like the book value of the assets that you have on hand. And we'll kind of look over this later. We'll actually look at a fixed asset, a depreciation schedule later. So hopefully it'll be easier to understand once we see that schedule. If we come back here, so here's depreciation. Like there are different ways to calculate depreciation. So that's this next thing here. So I put some of the ways that it can be calculated. It could be like a declining balance, sum of years, unit of production. These are just some of the ways that it can be done. And of course, I posted the most common method, which is a straight line basis. So by definition, this is the method of accounting for depreciation that assumes an asset loses value at a constant rate. The template uses the straight line basis, and everywhere I have worked also works on a straight line basis. So this is by far the most common depreciation method. Honestly, like these methods are very unique, and I've only calculated them in school. So in the real world, mostly it's straight line, but I would consult a tax accountant or tax attorney to see which might be more appropriate for your business. But in this video, we're mainly going to do straight line basis in both this template and also the schedule that we're going to go over. So if we looked at this, here is basically all of the assets given its useful life. Like this is basically what the depreciation is. And so here it's calculating all of the depreciation and the totals and cumulative over the years. So like this is what is considered the accumulated depreciation, because every month, every year, you're going to book depreciation, but it's cumulative. And so at the end of year one, like ending depreciation, it's going to be about $2,000. At the end of the second year, it's going to be about 6, and then the third year is going to be about 16. So if we go back to the balance sheet, it should match. So here's 2, and then accumulated is 8, because you add everything together. So for the second year, it was just 6 by itself. So both together is going to be 8, and then the final year was 16. So all of that together is going to be 25 on the balance sheet. And I will note that for tax purposes, there is something called Section 179, where you can, instead of, let me just read it first. Okay, an immediate expense deduction that business owners can take for purchases of depreciable business equipment instead of capitalizing or depreciating the asset over a period of time. So what that means is, instead of having to wait, 5 years, 7 years to depreciate an asset, you could immediately depreciate the whole thing in 1 year. But for 179, there are certain limits to 179. So again, please consult a tax attorney, tax accountant, to see what you can accelerate in terms of depreciation. Okay. And so with this, I wanted to show what a fixed asset schedule could look like. So here is like the different types of assets, cars, furniture, leasehold improvements, computers, etc. So they're all on here as an asset type. And so if you have an acquisition date or purchase date, and if you put the asset value in a column, if you know what they are, and you have a certain, this would be the useful life, you can calculate out, like, okay, given that a work van is about 20 grand and useful life of 5, you know that every year you're going to depreciate this for $4,000 a year in depreciation. And every month is about, $300. So the depreciation schedule here in the template, it's consolidating everything down to one number. So here it's basically like this number in the template. So it's a simplified depreciation schedule, where this just and versus a fixed asset schedule will kind of name every single item that you have and break it down by the type, the useful life, and calculating out what the depreciation would be every year and every month. And so this is an example of what it would look like. So like this asset value here, let's see if I can pull this over. So this like full purchase price, that is what you would see in the balance sheet here under the fixed assets. So this would be the asset value comes into the balance sheet here and also here. And then once you calculate out what it is per month, per year, like this depreciation or the cost, that's going to go onto the P&L. And then the accumulated depreciation here is going to come onto the balance sheet, and then you're going to have a net value. So that net value is the book value. So here is a nice schedule that kind of shows a snapshot of what your assets are at any given time. So this is as of the end of this year. If I bought and acquired all of these assets on January 1st of 2024, like at the end of the year, this is what my balance sheet should show. Like I should have 300K in fixed assets. I should have about $16,000 in accumulated depreciation, and the net value or the book value should be, 284. That's what it should be. And if you have a dynamic schedule like this, like once you age out, so the end of next year, it's going to change a little bit. So the depreciation keeps getting booked. The accumulated depreciation goes up, and so the net value or the book value, progressively goes down until something is fully depreciated. So if I acquired something in 2024, the useful life is about 5 years. Then by, 2030, these assets that are 5 years old should have fully depreciated. And we can kind of see that here. So at the end of 5 years, this $20,000 work fan, it's been in use, you've depreciated for at least 5 years, and so it's now fully depreciated, and so the book value or the net value of this item is $0. Even if you're still using it, if you're able to maintain the van for more than 5 years, that's great. But it's a fully depreciated asset at that point. So if you get rid of it, then you would just kind of write off this asset. If you sell it, because there's technically no value to this asset, the book value is $0. So if you sold it for, $2,000-$3,000, you would make a gain on that sale, and that's how you would book the sale of a fixed asset in that case. If you sold something, let's say like furniture, if you sold something for, let's say, $50, you have all this furniture, you want to get rid of it. If the book value is like $120 and you sold it, on Facebook Marketplace for $50, you technically took a loss on that asset, on that furniture, because it was valued at $120. So you would book that, you would write off this asset, and then you would put a loss of like $60 onto the books. $60-$70 when the furniture is sold. So that's kind of how fixed assets work. And if you have a bunch of fixed assets, I would recommend sort of a depreciation schedule like this, just so you can see it. And of course, it should match your financials. The overall asset value, accumulated depreciation, and the book value, you should be able to match that to the financials on the balance sheet. So that is sort of an overview of depreciation. And so we're moving on to amortization. So it's a very similar concept. Okay, depreciation and amortization are very, very similar. So the main difference is that amortization is an accounting technique used to periodically lower the book value, okay, of a loan or an intangible asset over a set period of time. So depreciation is for like physical assets, and amortization is for intangible assets. So over here in the balance sheet, like depreciation is appropriate for PP&E, plant, property, and equipment, and amortization would be appropriate for these intangible assets. And so, whatever you have intellectual property, they might have an expiration date. Your copyright may have also some sort of expiration date. So amortization will account for that. In the template, there's a special rule, IRS rule, where you can amortize some startup costs. So that's what's in this template. So the last couple of sections is amortizing the startup costs. And so this, okay, here, if I go to the starting point, all right. So that is here, like these startup costs, they are part of opening up the business, but you paid for them already. So there's a bunch of investment that you made into the business to start up the business. So they're technically not on your books anywhere because you paid for it already, with your capital, operating capital. So what the IRS says is that some of that amount, and again, IRS Section 195 sort of give guidelines on how and what you can amortize as startup costs. So I would reference that and also work with a tax accountant, a tax attorney, okay? But yeah, so these are basically the startup cost for the business. And so IRS allows you to amortize those over the first couple of years of your business. So that's what this is. And so which one do I use? This one, I guess. So the amortization that comes onto your income statement. All right, yeah. So here's like the amortized startup cost, and any amortization and depreciation, they will sit in the other expenses section of the financials. And you'll amortize them until it's been fully amortized, until the costs have been fully recognized. And the prepaid, that's probably here. So like as you're paying down or amortizing the prepaid expenses, like this is going to keep going down until it's fully paid, in quotes. And that's why amortization works for loans as well. If you had a loan and you keep paying it down, then that is also in accounting, you're amortizing the loan until the balance is $0. So this is amortization. And I think with that, we have covered amortization and depreciation. And we've reached the end of the financial projections template. And again, when it comes to depreciation, amortization, please consult like a professional, a tax professional, just to make sure your depreciation is okay. And so with that, if you need any additional support, I guess with this particular template, if you need help building a depreciation or amortization schedule for you, any sort of additional support, you can reach out to me. Okay, there's a QR code that will open up to a contact form. I'm also on SuperProf, to provide tutoring services. So I'll have that in the description below. Like and comment if you enjoyed this video series on the financial projections templates. I will be kicking off a new series on QuickBooks fundamentals, so please subscribe to sort of keep up with that. And thanks for watching.